Hey everyone, it's Andrew here. So yes, I think KPG was worth investing a small amount of money into, even though it is just fairly valued. Not a bargain at all. So let me explain why I decided to buy KPG and sell my Nintendo stake. Maybe I open your eyes up to paying up for a fantastic business. Now, the reason why I'm doing any of this, like these videos here on my channel, is because I found that just financial content online is mostly disgusting, and I felt that if I show my entire stock portfolio, that transparency makes me vulnerable to criticism, but responsible for what I say. Now, I'm not into crypto, NFTs, penny mining stocks, so here in my channel is my no approach to long-term investing and wealth. So KPG is an Australian accounting business acquirer that partners with other accounting businesses for the long term. So let me start with the big picture. KPG, I think, has all the attributes of a 100 bagger. They have a long runway ahead of them. Small and medium-sized accounting businesses in Australia have a market size of around $12 billion apparently. Acquisitions of accounting practices is quite a niche, yet the industry is vital for small businesses in Australia. At 180 million market cap or thereabouts, there is lots of room to grow into. KPG has a high internal return on invested capital. For 5 years now running at 25% plus per annum, showing that this acquisition strategy plus some organic growth is a profitable idea. Essentially, buying accounting businesses at 3 to 5 times their net income is going to get you that 25% return on invested capital. Next, I believe the business is really well run. Brett Kelly, the founder and CEO, and Kenneth, the COO, are thoughtful and understanding of what quality shareholders are looking for. Not only a great business model with a competitive advantage, but run with integrity and transparency. They're following the example set by Warren Buffett of Berkshire Hathaway, Mark Leonard of Constellation Software, and other great CEOs. If I was to run a public company, I would try to run it like Brett, but I'm definitely not as good. And I know from experience, the customers of accounting businesses in Australia are extremely sticky. See, my father has been with the same small business accountant for 30 years now. I have an accountant for one of my businesses, and there is no chance I could be bothered switching because they do a good job. I don't want to keep up with the tax legislation in Australia and figure out the best way to reduce my tax burden each year. A good accountant sticks with a good business for decades. And a good accountant will generally save you far more money than their fees. So it's just a rock solid industry. I can't imagine anytime soon a scenario where the business owners start wanting to figure out how to save money on their tax bills or enjoy figuring out how to structure their business correctly. So I think the accounting practice business is here for the long term. Next, I really like that Brett Kelly has over 50% ownership in the stock of the company. So he is highly incentivized as most of his net worth is tied up in the business. And as shareholders, we are partnering up with him. We are treated the same as him. It's a well incentivized structure. Here on the screen is how the revenue has grown over the past, I think it's 15, 16 years now. And as you can see, it's the compound annual growth rate has been 30% per annum. So that is a long history of exceptional growth. And I'm going to show you why I think that can continue. So here is the history of the acquisitions. And this is why I think it can continue that revenue growth. It's because early on, they made about the first, I think it's 5 or 6 years there, they've made 6 acquisitions, then it was 8 acquisitions, and it's pushed up to 20. So as this business gains momentum and more cash flow comes into the business, there are going to be more acquisitions going to be able to be made because they're able to purchase more. Now, I know Brett has said that he's going to go after lots of small acquisitions than 1 or 2 big acquisitions. He prefers the smaller ones. I think that's a great strategy. It doesn't put the business in any jeopardy or any risk by taking on a really big accounting firm. If that struggles, then it really affects the business. I really like this idea. And because there is thousands of these accounting businesses throughout Australia, this can continue on for quite a long time. Now, that is a bit of speculation, so I will address this a little bit later, where I think this could be one of the risks with this business. So I'll talk about that more a bit later. Now, this page here is the return on invested capital, and it's calculated the same way here on this slide as Constellation Software would have done this. And Mark Leonard is a very interesting guy, and I've studied him quite a lot in detail before. And he talks about how that essentially the shareholder capital generally correlates to the return on invested capital plus the organic revenue growth of the business combined. So if you can imagine one of these accounting businesses, and they just increase their fees a little bit, or they get a few more clients or something like that, that would be organic revenue growth of that particular accounting practice. And if they lose a few clients or something like that, that organic revenue would go down. So if they're targeting around about 5% organic revenue growth, so if all the accounting practices can increase their fees with inflation or the CPI and maybe get a few clients along the way, that would be around about that 5% mark. Tie that in with the return on invested capital of the business, of Kelly Partners Group, acquiring businesses at 3 to 5 times earnings, then combine that together, and that's actually quite in line. As you can see here, the last 5 years has been 31%, and we looked at the revenue compound annual growth rate of about 30%. So we're looking at a growth rate of the business here of around about that 30% range. Now that's not on a per share basis. I'll get to growth metrics a little bit later, but as you can see, 30% is very, very strong, and hopefully they can continue that. Now, regarding Chuck Acree's 3-legged stool criteria, the first leg, KPG has a strong rate of return with that return on invested capital well above 25% and proven for a long period of time. We have the second leg with a smart, high integrity and highly incentivized management team. And we have the third leg, which is lots of reinvestment opportunities to come. But that leads me to the potential issues. So, Constellation Software was able to acquire software businesses in Canada for 4 times profit for many years. But as they became bigger, other copycat businesses saw the opportunity as well. So competition to buy the software companies became more fierce, and Constellation had to start buying them at 5 or 6 times. Plus, they missed a lot of deals because competitors had bought them before they could look at them. Lucky there were still plenty to go around, but the increased competition did slow that return on invested capital and the growth of the business. So KPG could hit a similar issue in the future. As their story gets out there, other people will start to attempt similar methods, and the acquisition targets might get a little harder to buy. Something to keep an eye on. Now, paying fair price is something I've been fighting myself with for about a year now with KPG. In truth, it took me a long time to feel good about the business, but the more companies I studied, the more I realized how good KPG was. The more books I read and the great investors I'd learnt about, the more attracted I was to KPG. So here's the valuation that I've been working on. Now, this is my discounted cash flow model. Now, look, don't take this as this is exactly correct or anything like that. Look, predicting the future is very difficult to do. We're just trying to get a bit of a ballpark into what we could expect in the future from this investment. We just don't want to pay way too much for it. And we just want to see if there's a serious bargain to be had as well. And this, I think, gives us a pretty good idea of, a fair price at least to pay. So now I've just said growth rates for the next 10 years are going to be 15%. As we saw earlier, it's 25% plus and has been for quite a while now. I just think I want to be conservative. I can't predict the ups and downs of the industry, of the market, of anything. So look, let's put it down to 15% just to be, a little bit more conservative. My return on investment goal here, I'm just using a discount rate. I've just used 18%. It'd be nice to get 15%. There's a little margin of safety then built in, targeting 18%. The multiple I could sell it for, if it's growing at like sort of 15% and has been for quite a long time, I think you could probably get 25. Maybe that's a bit aggressive. Let's call it 20, maybe 20. So that really affected the price I wanted to buy it at, but I'll show you in a moment that it's probably not going to be a big deal anyway. The operating cash flow minus maintenance capex, I've gone and found that number. The shares outstanding is going to be pretty stable, I think, for a while. Brett actually said himself he wanted it to be a nice round number, so it's at exactly 45 million right now, and I think he's going to be pretty happy keeping it there. So that'll be the case. It's very important for KPG and Brett that they don't they don't want to dilute shareholders for their acquisitions. They're going to acquire businesses based on their cash that they have and the debt that they can get. So I feel really confident that this number is not going to blow out at any stage. So it says I want to buy this at 327. If I put it back up to the multiple at 25, we're talking about $3.80. The day I'm recording this, that's around about what the share price is, about $3.80. Now let me show you how I originally was valuing the company. What I was doing is I was using a discount rate of I think I was using 26%, and I think my growth rates were a little bit higher when I was doing this a while ago. And I was always thinking, at around about that 250, that's what I really wanted to pay. And that's what I've been wanting to pay for the last sort of 6 to 12 months. I guess when I really got confident in the idea, essentially I watched this from $2 go to $5 and go, you know what, it's out of reach now. But after really studying the company, I do think that the numbers that I had just a second ago, yeah, we're only going to get, potentially 15% return on this investment. But I think a 15% return on investment is really strong, considering that I think it's very likely to happen, more likely than a lot of companies that I've seen. And if I go a little bit more aggressive and think they can get something closer to 25%, well, they've been 30%, remember. So I'm talking now at with my 26% discount rate, around $4. If I'm really chasing a big discount rate, $3 would be amazing, but somewhere around the price it is now is actually probably pretty good buying. And I think that's where I've got to. So after the last 18 months, eventually the way I saw the business was like this. If I believe in Brett and that he can continue to execute the plan, then in 20 years, the business could be a $10 billion market cap business. I think that's the destination because it doesn't have to stop in Australia. Constellation Software expanded into the US and Europe, and I don't see why KPG couldn't at least go over to New Zealand. So at a market cap of 180 million or 250 million or 100 million, turning that into 10 billion is still a lot of money. That would be a share price of about $200. So paying $4 or $3 or $1 or $6, given a long enough time frame, should still turn out really well. It's a little bit of that Terry Smith from Fundsmith approach, but I actually think it's more like See's Candy and the Charlie Munger approach. Well, that's how good I think this might be. But at the back of my brain, I keep thinking, well, have I really got this right? I don't know. I think I have, but maybe I don't. So I have just got a starter position at the moment. I'll slow my thinking down and see how that feels, give it some time, I'll read some more on the business and go from there. I might accumulate a position over the next few years, and that's fine with me. And if you are looking to invest in any stocks, I recommend Interactive Brokers. They are the best, they're the safest broker to use for your investing. There's a link in the description if you want to take a demo account for a spin and see how it all works. I have demo videos here on the channel too. I also have an e-magazine where I share my thoughts on the market, plus my watch list with updated intrinsic values. KPG will be there. There's a link in the description as well. Now, why did I sell Nintendo to make room for KPG? Well, it was actually kind of simple. I really like Nintendo as a business. They are a fortress. Their brands are wonderful. They will be around for decades more and loved across generations. The financials are rock solid, and there's many opportunities to grow further. But I had a look at my portfolio and realized that Nintendo just can't do what KPG could do to my portfolio. KPG, I think, could be a 100 bagger. Nintendo, well, it's practically impossible to go up even 50x because they're already so big. So yeah, maybe I'll get a great return over a decade, but it doesn't have the upside that KPG has. So out of my large cap companies, this was the one that I thought had the least upside. Management doesn't seem to be reinvesting their cash like the other businesses in my portfolio. And although that is nice and conservative, it also is not going to get the potential returns that I dare to dream about. Still, I think Nintendo is a great business and still wish I could own it, but KPG is just superior as an investment. And KPG is superior because it is a smaller company with a simpler path to growth. There's also a highly incentivized owner and founder at the helm. There's a strong, proven rate of return that I believe the industry stability will allow for this to continue for a long time. And I think Brett Kelly is a superior capital allocator to the Nintendo management team at the moment. Obviously, I feel like I don't need to say this, but do your own research and come to your own conclusions. If I get hit by a truck and you don't know why you invested, well, you will have no idea what to do. So you need to have your own convictions about any investment. Give the video a thumbs up if you like KPG. Thanks for getting this far, and see you in the next video.